I'm one with Pete, so it's good to be in the chair with you.
It is, mate. Recording. We record this during the week, but it goes live on a Sunday morning. Bit of a digest of what's happened on the week, and I always tune in and love it. Once again, like when I filled in for you, I was definitely like Pete was carrying me. It's fair to say, but this week it's you carrying me in Pete's absence. But what have you been up to, mate, this week?
Oh, this week's been a big week. My daughter had an operation, so that was we had more anxiety than she did going into that. But it all went well. It was only adenoids and grommets, but just getting ready for that and getting her through that was the big sort of life thing. And we did a rebrand, went finally live last week, and lots is happening on the new hire started a few weeks ago. So lots happening on the business side and personal. So things are good.
That's good. Glad to hear she's doing well, mate. Of course. And I know, like, you and I chat a lot, right, about business and about life in general. But how's business going in terms of, like, is it just like since you won the award not too long ago, you got the rebrand happening? It seems like a lot is moving and underway at Blast.
Yeah, I mean, it was always a market-driven, right, sentiment. And I think that's definitely seen what we've seen is slowly gradual increase in positive sentiment all the way back to sort of October, November, December last year. We could, as brokers, we're very leading indicators on what people are thinking, what they're feeling, how their approach is, what they're scared around property, because they come to us first. And so we could see that, people were a little bit like, well, actually, maybe it is a good time to buy all the way back in December. And you can see CoreLogic have come out with numbers to show that over the first quarter, prices actually went up a lot around the country. But we could see that back then. And I think once rates would stop going up last month, even though they went up, this month, which we'll talk about, but that was like one of the final things people would go, oh, deep sigh of relief. Maybe they're not going to go up to these crazy levels. And the media started to shift. There was, the boom is coming back and all that sort of clickbait media was back in the media. And we also see a huge increase in people coming to us that, oh, actually, no, I don't want to miss the bottom. Now's a good time to buy. So that pent up demand starts to come to us. So absolutely the sentiment and the inquiry's gone up a lot. And people's, desire and urgency, the buyer urgency is the key thing. So you want to get ready, you want to buy, but if you're not urgent, then you don't actually go on transaction. You just sit on your hands. And so, absolutely. People are out there making offers and going to auctions, which is another thing we'll talk about today.
Yeah, we're going to touch briefly on the RBA rate increase, which you mentioned. We're going to share a bit of a resources, insight, what you would look at, what Pete looks at, what people in the industry look at, which is from CoreLogic. It's a monthly pack, which we'll put a link in the show notes to. And then we've got a bit of a dissect of the budget night, which is interesting in a few different ways. And then finally, just touch on the clearance rates, which have been pretty strong recently, and kind of just lead on from what you just said there. But mate, maybe get the ball rolling. I've obviously been in about a week or so for people to digest the latest RBA rate increase. I guess, what did you make of that? Like the RBA saying that they wanted to bring forward basically their expectation of hitting that 2 to 3% band, and hence the rate increase. Most economists didn't predict it. Some did. Is this the end of the cycle? Just general thoughts.
Yeah, I think I got interviewed on the Monday, I think it was, prior to it. And I looked at the market. The market said 0% chance of a rate increase. I joked with the journalist. We had to give him two quotes. What happens if the rates go up? What happens if the rates don't go up? And I was like, well, it's probably no point talking about rates going up. But then the market always teaches you a lesson, right? The market is you, and that's over 13 years in financial advice. I learned that lesson so many times, right? And I think that's the interesting thing. But I think it makes sense though, right? Because you could already see, they would already be able to see there's a bit of positive news flow into the property market, the wealth effect that creates. They potentially see that the last thing they want to do is get this inflation genie under control and then it to drag on, and so I think it actually, on reflection, in hindsight, it makes sense just to maybe give us one or two more rate increases, just give us a couple more slaps and make sure that we stop our spending just so we can get inflation under control. Because the last thing they want to do is start to see some really positive news in the property market. People feel wealthier again and people go back and spend, and they're not worried about rates because their asset prices are going up. And so, on reflection, it makes sense. But when you look at the market pricing again, it's zero, chance next month. So maybe there is still one more, but it can't be like 5 or 6 more, right? And what all the market's saying is if inflation does get under control, there'll be quite significant cuts. One other thing we're going to potentially touch on today is building approvals. I mean, they're at all-time lows, right? And so we can see there's these huge headwinds coming for the economy down the line. Let's say that's just the construction industry, where they're going to want to have to stimulate demand, and that's potentially things like rate cuts. So I would say that we're getting very close to the end of the rate cycle, but I also think buyers weren't deterred. Like, all the clients that we've got pre-approved didn't think, oh, I'm not going to buy now because there's been one more rate increase. They're in the market. They're not concerned about that. They're more focused on they're not as worried as they were in 2022 when rates were just going up 50 basis points at a time. So yeah, I think it's no matter what happened, it didn't really affect buyer demand. And I don't think it's going to change seller behavior at all either. So it's a bit of a non-event, really.
Yeah, I mean, we'll talk about clearance rates in just a moment, but even the unemployment rate still so strong. And implying, people are still fully employed. We actually, on our Australian Finance podcast, we spoke to Matt Cowgill from Seek, economist at Seek, and he said that they're seeing so much activity, like huge number of listings for jobs, and also what he seems to be finding in the data is that a lot of people are switching careers and switching jobs and getting the pay rises that they want because the market is so tight. And so I guess what the RBA is just trying to be cautious in that view of reaching that target, because if they're not, like you said, if it's in the bottle but it's kind of just still tipping over every time, it's going to keep rising. But what do you think then, like with the rhetoric recently about prices, like house prices going up in 2023, and you talk about the wealth effect, right? What do you think the implications are there for the RBA? Like, do you think that would spook them then if we see the wealth effect kicking off? May they have to increase again?
I think you're right around the worker mobility. I think that's a key issue. And I there was a whole talk about the great resignation, right? There was this huge wave. Everyone's going to quit their jobs coming out of COVID and go and finally pursue the job they always wanted to. I would say that that's really, being killed, right? I'd say that, I know Seek's saying there's a lot of opportunities out there and people are doing it. But through the conversations that I'm having with clients, redundancy is a common thing we're talking about. Yeah. People are very nervous around, the clients who are a bit concerned around their jobs, in tech industry and lots of different industries. They're a bit apprehensive on going into debt. So I would say it's, 2021, everyone was very confident around their jobs and things like that. But I would say, 2022, 2023, I would say that people are a little bit more concerned around a recession, maybe getting made redundant, and that's going to slow down the people willing to quit and take and look. True. So I would say that's probably a good sign, I guess, for getting inflation under control, because we don't get this wage price spiral where people are swapping jobs, getting pay rise, costs are going up, prices have to go up, etc. I do think the wealth effect's probably a good thing. I mean, they don't really want house prices to keep falling, right? But I think it's just, I don't think they're expecting a big run in prices in the short term unless there's quite significant cuts. And there's probably not going to be significant cuts till inflation's under control. So I would say there's going to be a support to property prices, maybe not a big collapse in property prices. But what's also going to make property prices go up a lot is rate cuts and borrowing capacity increasing. And those two will probably come at the same time, because the rate cuts will increase borrowing capacity. And that's also the perfect time for APRA to step in and reduce the assessment rate, because it can say, well, why would I have a 3% assessment rate above the current rate, which is really conservative, when rates are going down, when we potentially... And so I didn't think they were worried about a run in prices, but I'd say they're pretty happy to see a support in prices rather than prices keep falling and you've got bank issues and all that sort of thing.
There's one, obviously I'd be remiss not to ask you, mate, about like people in the finance process, or even people like myself, right, who have a mortgage. What are we seeing in terms of, don't want to use the word, but the dichotomy or the difference between fixed rates and variable rates for people in the market now? Are we starting to see that shift in I guess, back towards, like, I'm hopeful as a 100% variable mortgage holder that potentially we start to see the rates on fixed rates become more appealing in time? Like, how are you seeing that?
So there is potentially a little bit of a benefit, especially with the last rate increase. The 1 year fixed rates we've been doing a few of those, not many. So probably 90+% of our loans are going down on variable. 2021, 2022, 80, 90%. Well, definitely 2021, 80% of our loans were fixed, right? Because they were getting fixed rates in the 2s, and even high 1s. So I would say definitely it's still a big swing to variable rates and long, but fixed rates have been coming down. So that's also a good sign that longer term rates and longer term funding's getting cheaper. And so, but I would say it's still not a good bet, because if you, depending on what happens to, the inflation story, if there was the big rate cuts next year, those fixed rates would very quickly be out of market, right? So I'd say you have to be very concerned around your cash flow and be willing to, take that risk that you could be out of market if rates do get cut, which I just don't think we'd really want to encourage our clients. So the 1 year fixed rate, I mean, I fixed for 1 year on my loans, a few weeks ago. I actually thought when the rate story changed, when rates weren't going to go up, I was like, oh no, maybe I shouldn't have fixed. But then there was that extra rate increase, which was a good decision in the end. But that's the issue with rates. I mean, you wouldn't want to fix very long.
Yeah, absolutely. Like what we would call on the other side of the fence, duration is the key thing to think about. I don't want to bore people with the theoretical side of that, but so the other thing that we wanted to talk about and touch on, which is more of like a helpful resource, which I didn't know about until coming into today's recording, mate, which is this idea that CoreLogic puts out a monthly resources pack for property for anyone interested in the economy or property generally speaking. And you can access this, if I'm not mistaken, every month. It's totally free. Yep. We'll put a link in the show notes to it. It's from CoreLogic, who many of you will know. But maybe if we pull like a couple of things out of that resources pack and just kind of riff from there.
Yeah, absolutely. Whenever it is released, I'm downloading it that same day. And, there's lots of great points in it. I mean, it says there's 10.9 million dwellings. It shows that the value of property is like 9.5 trillion, but there's only $2.2 trillion of debt in the property market. Like, you can get some really great stats like that. You can see how many sales there are per year there's 470,000 sales as a country, per year. So you get a real good bird's eye view, but then it goes down to really tracking price changes. And what I love in this, you can also see listings changes and actually how many sales are going through in each city and compared to longer term averages. What's some interesting things, I guess, this month, days on market in the capitals have sort of come back down. It was really increasing all the way through 2022. So that's a good sign that properties are selling a bit faster. Even the discounts starting to reduce. That's how much vendors have to reduce their prices. But the key thing, I think, in this report, it kind of shows is that listings have just never sprung in spring. They just didn't go up. There's usually a real increase in listings in spring, late in 2022. That didn't happen. But it also was really underwhelming in, autumn in 2023. There just wasn't many new listings. And new listings is supply. So when the supply gets really tight of something, that supports prices. And you can see total listings in the country are just ridiculously low, right? They're 30% under 5-year average, right? And you can see in some cities it's, where listings have gone up, right? Like Hobart and, regional Victoria and regional Tasmania listings are up a lot. But if you look at a lot of the other places in the country, listings are down substantially. And another interesting thing I think in this report, I think it's something to always watch is it's just new dwelling approvals. And so you can see there was a huge increase in the COVID home builder time. And this has ended up being that a lot of builders are going bust because of the fixed price contracts, etc. But you can see that not just for houses, but for apartments and units, we've got a very small pipeline building of future supply, and that's really concerning when we're in a a rental crisis, and even for our construction industry, which is a big employer in our country.
That's it. It's both units and houses. Just to confirm for people, that are well below average, which is very concerning when you think about what's on the market, right? But then the forward order book, which is that the dwelling approvals, is also low. I think Pete mentioned in an email to us that it's for the quarterly figure, it's the lowest figure since 2012. So we've got, as I think me and you talked about this maybe a year or two ago, this idea of a profitless boom for a lot of these builders. And now we're kind of seeing all of those lack of profits come through and insolvencies rise. But it means that people aren't also buying off the plan. They're not, the demand's just not there. And that's got some real, I feel like, as the less educated one here, Chris, I feel like it's got some serious implications for not just what happens to prices now, but what happens to prices in 2, 3, 4 years, particularly against the backdrop of a lot of this stimulus that is supposedly and the government support for new dwellings. Like it's very interesting.
Yeah, we've got, big immigration. We've got people that are in their 20s getting married, moving out of home. There's new dwelling formation. We've got Simon coming on the podcast in the Kushta market from the demographics group. He's going to help us explain, household formation and how that is future supply of or demand that we need to be concerned of. So absolutely, I think we need to be building if we're growing our population and growing our households. And this is basically showing we're not. We're also seeing we do a lot of not so much helping people buy house and land or helping people buy, off the plan apartments, etc., but people doing construction. So, additions or alterations to their current property, and they come to us and ask for a construction loan.
Yep.
We saw a huge increase of that in 2020, 2021, right? People living more time at their home. People got their equity there. They can get access to money cheaply. So that has really dried up, because they're getting huge quotes when they go to do these renovations. B, then they have to have the equity to do that, which is harder now because valuations have come down. And then finally, do they want to when rates are 5 or 6%? Like, are you that motivated to do this renovation when it's high interest rates? Well, no. And so I think even for the more boutique builder that's maybe doing the $500 to $2 million renovations, they're going to really see some challenges in a couple of years' time because we're just not seeing that demand building. We're just not until you see rate cuts and still you see supports in prices and maybe till you see materials and labor come back down. And so, I do worry about them as well, who have maybe got a great pipeline for the next 1 or 2 years, maybe not that long, and then they're going to be some struggling times.
And then you'll probably also have a bit of an opportunity cost here, right? Just thinking, if your rates and your cost of what we would call cost of capital, like the money that you deploy into a reno is so high, you're probably more likely to make the conscious choice now in the trade-off. Well, do I renovate or do I look at a new place? Maybe this is my opportunity. If I do have the borrowing capacity, maybe this is the opportunity. Instead of that upgrading, let's maybe switch. I don't know if that's fair, but I know a lot of our community are looking for those construction loans and to renovate.
Yeah, absolutely. So a conversation right now is if you don't need to renovate, there's a couple of clients in the last couple of weeks I'm thinking about that have made the decision, we're not going to renovate in this environment. We're just going to live in our current property, but we're going to use our capacity still. And so we're going to go and buy an investment property or we're going to get into the markets and look at shares, etc. So, they're still getting access to that credit, but they're not going to put it into the construction industry. They're going to go and do further investing. And so, absolutely. Because, A, they get a return on that money from a rental income or dividends, etc. And B, they don't have to sort of wear this higher interest cost on their home through a renovation that they can just delay and do it in the future at a better price.
Well, the thing that we have to talk about on the show this week is this idea of the budget night, right? Everyone gets out, the journos get a bit of time in the data room to prepare their notes for the next day. And we had the budget out. It's back in black, is fair to say. Lots of booms in energy, oil, gas, coal, iron ore, record profits, big dollars for the government, moving that surplus ahead of time, which is really, I guess, impressive for our country. But as it relates to property, Chris, there were a few things that we could pull out. I think maybe one of the things that we wanted to talk about was this idea of this support for build to rent through multiple, I guess, lenses. You've got what we already know from the institutional level and from government support around infrastructure and so on and so forth, but right down to investors and depreciation rates. There's a lot to kind of unpack there.
Yeah.
But maybe just to fill people in, if they're new to the podcast, new to this idea of build to rent, can you just maybe explain that real quick before we jump into it?
Yeah, so I haven't got the exact numbers, but pretty much 98% of our properties are owned by individuals, right? Singles, couples, mums and dads. They're not owned by big corporates, right? There is a bit of social housing and things like that. So it's really the residential property market hasn't been attractive for super funds or for companies to invest in because a lot of the taxes, etc. And so what people do is build to sell. A developer would build it and sell it because it would be really expensive to hold on to properties, right? What they realize is that a lot of countries around the world is people do this sort of build to rent model, right? The US, in Europe, etc. And it's not a bad option for renters because instead of having this landlord kicking you out after a year because they want to sell it so they can upgrade their home or they want to buy another investment property, you could get long-term tenancy, right? And that's a great option, right? It could be great options for you, a couple or family. And so I'm really a big fan of build to rent because it gives people long-term rental security, right? The problem with the build to rent model is that it takes time to come up, buy the land, figure out what you can build on it, get the builder, build it. And so I think it's just going to take some many years. And also to get the funding in this, it does align really well with the superannuation industry. You can see Australian Super and a lot of the big super funds are becoming big players in it. Assembly, I think it is, they're a big developer who's working a lot with the super fund. So it's a really exciting time. And Mirvac are playing in this space a lot. And so what they basically do is creating more rental accommodation. The problem is it's not going to be rental accommodation for the middle and lower incomes and our key workers and our the people who probably need the help the most. This probably rental accommodation is going to be targeted at the more higher end. That's how they can make it profitable. I guess the benefit of that, if you take some of that demand from other places they're renting and move it into this, maybe there's a little bit less stress on other rental accommodation. But I just don't see build to rent really, and all around the world from what I've seen, is it is targeted at that more affluent sort of renter. And so the problem is as well, I mean, there's about 30,000 build to rents from my understanding in the pipeline. There's about 3 million rental properties, right? If not more. So potentially there's 1% more rental properties coming to the market. Or over 10 years, if you look at the plan, is maybe there's another 5%. So it's very little. It's not going to move the needle that much, I don't believe. But what the government's basically done is that said, look, one of the things holding back the sector was a really high land tax. And the way that depreciation works. What we'll do is we'll reduce the land tax from 30 to 15%. The industry's been calling for that. I think it's a really good idea. And we'll increase the amount that they can depreciate their assets. So that cost to benefit of whether they should, a super fund should make this investment in this development looks much more attractive. The return on equity looks much better now. And so we should get a lot more investment. And so that should be good for the construction industry, to be honest, because if we can't sell build to rent, if they can't sell build to sell, which is like off the plan, and a lot of people aren't doing house and land packages, right? Then this could be good for our construction industry. But I don't know if it's going to support the massive shortfall that we have coming.
Yeah, I mean, we were just talking off air about and I know you and Pete have touched on the various initiatives before, but like the 1 million houses, the 10,000 homes through the extra funding and whatever. I think the 1 million house goal is a very, very good political phrase to say we're going to add this much. But when you think about 11 million homes in the country, that's a very significant increase in a very, very short period of time when we already have substantial increases and dislocations in like building supplies and prices of steel, timber, trades. That can have adverse consequences. I think the strategy overall, though, is basically trying to align the federal government with state governments and local councils to unlock land, to release land, to improve zoning, to basically remove some of the friction points that are unnecessarily perhaps caused by the government and just release that, which makes a bit of sense. There are a few other things, just if I pull them out of the budget, I would say for the most part, kind of underwhelming as an overall thing for property investors. There was an increase in social and affordability rentals. We've obviously got the rental crisis, as if you like, rent assistance. There'll be an substantial increase in rent assistance. I think maybe the two things that are more targeted and a little bit more, I guess, interesting for people in and around these areas are one, which is the government basically put the Brisbane community on notice to say we are planning substantial investments in the Brisbane districts to support the 2032 Olympics, announcing that they'll spend up to $3.4 billion in investment for infrastructure. That's for the Olympic and Paralympic Games. But this is a lot of this is still to come, meaning that they've announced it now, but it's likely not to be actually. You're not going to see the impact of this for a few years. And the other one, Chris, was the stadiums, that one new stadium and a stadium upgrade to Launceston for the AFL in Tasmania. Basically, the AFL, for those of you that aren't in Victoria like I normally am, the AFL is looking to increase its presence in Tasmania and to take a team down there, because in the current AFL system there isn't one, although North Melbourne and the Hawthorn team tend to play there a lot. And so it's basically a massive amount of stimulus, hundreds of millions of dollars going into Tasmania in really targeted areas to try and improve that the sporting code down there, which could have small impacts for people in the areas. That's quite contentious. But those two things were probably the two key points around infrastructure spending. like I said, unless you're investing in Brisbane or Hobart, it's probably not something that's on your radar. But I thought I'd call that out. But other than that, Chris, there was a few little things like subsidies and low interest loans for people that buy energy efficient white goods, solar panels, and these types of things, as well as a few once-off things for particular groups around utility bills and subsidies and the like. But I'd say pretty underwhelming overall is my take.
Yeah, the only thing to add is there's a 5% deposit home loan scheme, right? That the government offers. 35,000 people can get access to it. I would say the demand for that scheme is really low, just because of a lot of first home buyers are really nervous with the market and interest rates, and what they can borrow has come down a lot. So what they've done is it's not getting the places really used. So they said, well, how can we allow more people to get access to it? So spouses and people who have maybe bought a property over 10 years ago. And so there's a real increase into the eligibility requirements, I guess. And so that's I think that's a good move. I think that I was a little bit anti that policy at first when it came out, because you're just creating more demand. But I think ultimately in a down market, when the market needs support, it does make sense, because they introduced that when the market was going up a lot, right? And so you've got to be really careful adding more more sticks to the fire at that point. The thing you said around the million homes, I do think in a rental crisis, in very low vacancy rates, in high migration, that is going to create a social issue on both levels. I can't afford to buy, but I also can't afford to rent.
Yeah.
You start to get real frustrations in the city on both levels. Even if you've got a rental property, you're paying more rent and you'd love to buy. And so I think this YIMBY movement, where it's people are saying, look, we want more homes, we want more available housing in the areas we want to live. I think that's going to have a really good push behind it in the next few years. And I think councils are going to have to potentially be a bit more relaxed around zoning, because I think that there's going to be enough voice also coming from the parents of these kids. They're seeing the frustrations of their kids and what they're having to deal with. And so I think that, along main roads, around train stations, around the key, even in the places that usually wouldn't get development, I think they're going to be potentially a little bit more open to it, because there's going to be a bit more pressure from the local councils, the state council, the federal government to really unlock housing, which everyone's been sort of, trying to not allow more housing in a lot of these postcodes for so long. So that would be my take at the moment. The movement's potentially shifting the other way.
Yeah, well, it's a signal, isn't it? Right. Like, it's the government signaling to say we're going to get alignment between everyone. And we've seen various states do this as well, with trying to ease and unlock certain areas, but it hasn't had really the concerted support of like all levels of government. So I agree with you. It's kind of like the beginning of a wave that's going to shift through all parts of the country, and that's good news for investors.
Yeah,
it's very good news for investors, even homeowners right now. So all in all, pretty positive. And I guess it's just a play it by ear with the whether or not we reach anything like 1 million homes. We'll see. But mate, the final thing that we wanted to talk about today is basically the rise in clearance rates. And it probably makes a lot of sense to folks who are listening and thinking, well, you just said, supply's down, demand's up. Probably makes a lot of sense, but it was surprisingly very strong at the weekend. And this is 5 days after a rate increase.
Yeah, a lot of people in the property market go on and they track the clearance rate like it's gospel. It's the one indicator that says everything you need to know about the property market. That's definitely not the case. But what I call the clearance rate is the desperation meter, right? The higher that goes, it means that buyers are more and more desperate and they're willing to buy properties no matter what, right? Because not every property at an auction should be selling, right? A lot of them are not great assets. And so there should always be some properties that aren't transacting. The vendor thinks it's worth more than it actually is. In boom times, though, the clearance rates go through the roof. And I just think that's a sign of how much desperation or FOMO is in the market. But you can see that it's gone, close to 80%, in Sydney, Melbourne, in Adelaide, it's really strong, etc. So I would just say that the clearance rates have really jumped. And it was surprising a lot of people how high they're going, which is a real sign that, low listings, and also people are getting more desperate. And so people are more willing to make compromises. And I think even in higher rates environment, you should also want to make less compromises, because why would I want to buy that property, pay a lot of interest if it wasn't a great property? So to see people getting desperate in a high interest rate environment is pretty concerning when potentially what would happen if rates started to fall, right? So this is only because rates are starting to pause, not that rates are falling, right, and not markets running on them. So, I was surprised to see it jumping so much so early in a recovery, I guess. And that's a real positive sign for prices, and that may not be positive for you if you're trying to buy.
Yeah, well, we've also seen that something we didn't really touch on before is this idea of like the regions are also tending the data around the regions. You can see it in the CoreLogic data. Are starting to plateau as well. So meaning that there's probably what we've been talking about a bit on the show recently, which is that there tends to be the migration back to the cities where people want to be in the office and companies want you in the office, and that has an impact as well to the supply and demand dynamic in these hotbeds. So. It's pretty like, I don't know, Chris. I feel like as someone looking to buy right now, it's a fascinating market in terms of the high rates combined with the lack of supply, but also the fear of what all the things that we're just talking about like the forward order looks like it could get worse before it gets better, like in the medium term. So, I mean, what's a buyer to do in this market?
I think the key is being patient and persistent, and that's in any market. The last thing you want to do now is just jump at this potential FOMO and go, oh, if I don't buy now, prices are going to run on me, and buy a poor asset. Because if rates do stay higher for longer than people expect, there could be more pain ahead. And also, if you decided to sell the property in a few years, you buy cost, you sell cost. So it's just being really, and even in the last year, it was just sort of been waiting for a good asset, which is really hard right now. A client we're helping at the moment, and we've had to realign them a few times. They're really keen on a property last week. It just comes out of desperation. They've been looking for 3-4 months now. And they're just tired. They just don't want to be looking anymore, right? And so that's also what happens is low stock creates this sort of exhaustion in the market, and then people start to get a bit irrational. So I would say that's the worst thing buyers should do right now, is just still be patient, still be persistent, because you have to be in the market to find that good asset. Because if the agent doesn't think you're in the market, then they won't give it to you, and they'll give it to some other buyer first option to look at it, and then they go and buy it, and you don't even know something happens. So in the market, waiting for a quality asset, stress testing your financials. Okay, even if rates did go up a bit more, can I pay it under higher interest rates? Getting a property that you've got a long time to live in, so not just a property that's going to last you for 3 or 4 years, right? A property that you can grow into, and maybe you do a renovation on it in the future. So it's sort of future-proof you as well. And then just doing all your real building and pest check, and just making sure you buy something that's structurally sound, because the last thing you want to then do is potentially have to do some remedial work under high labor and high materials and all those sort of things. So
with high funding costs.
Yeah. So it's just it's a real, it's not a market just to take on risk. And if you don't buy now, then a year's time, you're going to really regret it. I don't think it's that. But I also think it's a market that if you don't play in it, you potentially could wish you bought last year, when, they could start to see a stabilizing in prices, especially if there's talk of rate cuts and APRA step in next year. You could start to chase your tail a little bit.
Yeah. So I guess like the takeaway, which is, that's rather calming too, mate. So I appreciate that. It's the takeaway is like you have to be ready, but you have to be patient.
Yeah.
And that's probably the case for any market. I mean, the difference now is that a lot of people that may be in the rental market and looking to buy, 2 years ago, they didn't have the stress of the rental market necessarily. They still had to pay the rent, but didn't have the stress of it. And that's like an added pressure that they didn't have, as well as the higher funding costs. So, there's a lot to go on, mate.
Yeah, the rental market's an interesting one. So if you are in the worst thing I think you can do, it's just like when someone's trying to upgrade, is get out of, you've got this rental lease finishing, I don't know, on the 1st of September, and you're like, well, I want to buy something because I don't want to go back into the rental market. And then you try to find a property that's going to solve your housing issue. And you end up having to try to buy this perfect property on the right day and get it to settle on the perfect day so you can, move from your rental to your property. I think that's a really bad move. You'll act very emotionally. You'll buy the wrong property because you'll be focused on buying the property that suits your timeline, not what suits you from a lifestyle point of view, or what's an amazing investment. So if you're coming out of a rental and you do want to buy, my advice would be try to extend your lease, even if it is at the higher rent, just take that hit, get yourself a longer time frame, 12 months, and then just break the lease when you buy the right property. Because that break lease cost might be 4 weeks rent, but that's, a cost worth paying if it ensures you buy a great asset from an investment point of view and also the right property from a lifestyle point of view for you long term. So that is kind of like an insurance cost of protecting you from acting emotionally and buying the wrong property. And so that's what we also see. People coming in out of the rental market can quickly buy the wrong property because they go from one frying pan to another.
Absolutely. Yeah. I think your desperation meter, the higher that goes, the multiples higher the mistakes or probability of mistakes would go. So
absolutely.
Yeah. So just to summarize, man, we covered a lot of ground and we covered it pretty quickly today, but we'll have links in the show notes to all these resources. In particular, the monthly resource from CoreLogic. You'll find that in there. And it's just a great thing to just jump on and just have a look at the charts and see what interesting data is relevant to you, and if you just like to keep your finger on the pulse. But we talked just briefly about the RBA increase. Chris mentioned the interplay between fixed and variable at the moment is quite interesting, but don't want to kind of like lock yourself in for too long. And regret minimization is probably the framework I'd apply there. The CoreLogic resources pack, as I said, will be in the show notes. The days on market are coming down, listings are extremely low, dwelling approvals extremely low. Like we're not the first to say this, but it's happening. Budget night was pretty underwhelming overall. There's some pretty aspirational headlines there, but and some pretty aspirational forecasts across the board, not just as it relate to property. But a lot of support for build to rent, and we probably see that starting now. This is probably not a 1 or 2 year thing; it's probably a decade long thing. As well as some infrastructure spending in and around Brisbane in particular. So very interesting for those folks up there. And finally, clearance rates, huge increase. And kind of out of fashion as well, which is quite interesting. Maybe if we can get a patent on Chris's desperation meter, we'll be referencing that this time next year, and we'll see that spike. But mate, people can find you at blusk.au. There's always a link in the show notes, as well as getting in touch with Chris's team for mortgage broking. It's always great to work with Chris, and I'm delighted that we work with Chris in many different ways, but here on the podcast in particular. So mate, thanks for this. I hope the little one has a recovery. I know what it's like to get the old tonsils out and the adenoids and all that. So, yeah, really appreciate it, mate, and good luck to her.
Yeah, and everyone have a great